Welcome to Breaking News to Trading Moves. Today, we are focused on a pretty sudden reversal in the crypto market. Specifically, we're going to look at how this has affected publicly traded companies all across the financial world.
It's a really necessary thing to look at right now. The main event that's causing everyone to sort of rethink their risk exposure is Bitcoin's recent price action. After a period of, a lot of excitement and new all-time highs back in October, Bitcoin has now actually dropped below the level it closed at the end of 2024.
And the decline has been fast. I mean, the asset has erased more than 30% of its 2025 gains. This feels like more than just a little market hiccup. It points to a real move away from that speculative excitement we saw.
Absolutely. The result is that investors, whether we're talking about big institutions or just retail folks, they're all being forced to readjust their positions, and quickly. When we look at the material explaining the drivers behind this move into deeper bear market territory for crypto, three factors really stand out.
Okay, so what are those key drivers? What tells us this is more than just some quick selling?
First and foremost, there's just a general heightened risk-off feeling across all global markets. We're seeing a systemic move away from assets that are perceived as speculative or, ones that carry higher counterparty risk. When the big picture, the macro outlook, starts to look a little darker, the speculative corners of the market, like crypto, they often feel the pain first and hardest.
And the second point, we've seen some movement from within the crypto world itself, haven't we?
We have. That's the second driver. There have been large recorded outflows from the dedicated Bitcoin funds. When you see fund flows turn negative like that, it takes away a really vital source of buying pressure. These outflows are often seen as a kind of leading indicator that enthusiasm from both retail and institutions is starting to fade.
Right. And finally, the third driver you mentioned that speaks directly to the institutional story that was propping up the rally earlier this year, the ETF allocators.
That's correct. The institutional ETF allocators, the big managers who are responsible for putting capital to work across different asset classes, they seem to be stepping back. This suggests that the sustained structural demand is drying up. If the institutions aren't confident enough to buy at these levels, it signals a deeper structural issue for Bitcoin's whole narrative as this, easily allocatable institutional asset. They want sustained performance, they want regulatory clarity, and a rapid 30% drop definitely challenges that story.
So our mission now is to look beyond just the price of Bitcoin and analyze the resulting market structure. This kind of volatility creates immediate winners and losers, all depending on how they're positioned relative to risk.
Yeah, we need a clear way to classify this. We're identifying publicly traded companies and sectors that could benefit as capital moves towards safety and stability. And on the other side, those companies that are feeling some acute pressure because their business models are directly tied to that volatile asset price or its trading volumes. We're really just examining the consequences for these names.
Okay, let's start with the upside then. The potential beneficiaries of this flight from speculation. When capital leaves risk assets, we often see it pulled toward assets that have, performed reliably when the market is under stress. This takes us into our first section, capital rotation into more traditional value plays.
This is textbook market psychology, really. The first category that's benefiting here is gold, and the other established store of value plays. Specifically, we're talking about the companies that actually mine the metal.
The narrative for a while was that Bitcoin was going to be the new gold, right? The superior digital store of value. But when digital gold doesn't do its job during a period of fear, that capital flow reverses.
It does. And this is where market psychology really kicks in. When the shiny new asset fails that primary job of hedging against systemic risk, the fear of missing out on crypto turns into a very rational fear of losing everything. And that encourages a rotation back into the, let's call them old school hedges. We see investment capital moving back to physical gold, which has a multi-millennia track record of preserving value, even if it has less explosive growth potential.
And this movement supports the price of gold, which in turn helps out the large-scale miners. But why are we focusing on the majors like Newmont and Barrick Gold and not the smaller, more volatile junior miners?
That is a critical distinction to make during a true risk-off event. Investors who are fleeing speculative risk aren't just buying gold. They are looking for highly liquid, stable ways to get that exposure. Newmont, ticker NEAM, and Barrick Gold, ticker GOLLD, they offer that institutional-grade liquidity and stability.
Okay, so walk us through the specific advantages of these major players during this kind of rotation.
First thing is liquidity. Large institutional buyers, the same ETF allocators who might be pulling back from Bitcoin, they need massive liquidity to be able to move into a position quickly. NEM and GOLD have enough float and trading volume to absorb those large capital inflows without causing too much of a price disruption. The junior miner just can't offer that.
So it's not just about getting exposure to gold, it's about getting accessible, stable gold exposure.
Precisely. And second, these majors offer geopolitical stability and diversified operations. Their assets are spread out across multiple jurisdictions, which lowers the risk that comes with, say, a single mine operational issue or some local political problem. When investors are running scared, they want companies that minimize any uncompensated risk. Barrick Gold, for example, operates these massive long-life assets that provide confidence in their production for years to come, regardless of short-term market noise. Newmont has a very similar profile. The market just views these companies as less vulnerable to unexpected operational surprises than their smaller, single-asset competitors.
So the thesis here is that the Bitcoin sell-off is reinforcing the demand for institutional-grade gold exposure, and that demand is naturally being funneled toward NEM and GOLD.
That summarizes the rotation mechanism very well. They are seen as reliable, cash-generative businesses that are benefiting from a better commodity price environment. And that's a much easier proposition for an investor to stomach than the high volatility of crypto.
Let's move on to our second category. This one seems a little counterintuitive, but it says a lot about market structure. Large regulated exchanges, specifically those outside of the pure crypto space.
Right. This is where we look at the infrastructure that can actually profit from chaos. This category benefits not just from the crypto slowdown, but from the increased volatility and uncertainty that the risk-off sentiment causes to spill over into the broader financial system, equities, futures, and options trading.
So you're saying that a company like CME Group could be actively profiting from the same instability that's hurting the underlying asset of its competitors? That's a remarkable market positioning.
It is. The core strength of these institutions, CME Group, ticker CME, and NASDAQ, ticker NDAQ, is their diversified revenue streams and, maybe most importantly, their deep regulatory foundation. When uncertainty spikes, market participants rush to hedge risk or liquidate positions or speculate on future moves. All of those actions require transaction services.
So how does CME and NASDAQ capture this volatility revenue differently? We should probably break down the mechanics for each.
Absolutely. CME Group's business model is really centered on futures and options. When volatility rises, so does the demand for complex hedging tools. Companies, portfolio managers, speculators, they all use CME's products, from equity indices to currency and interest rate futures, to lay off their exposure or place levered bets. So increased volatility translates directly into higher trading volumes and often higher fees for the most complex in-demand products.
So CME is basically the essential toolkit for managing portfolio risk when the traditional markets are swinging wildly because of this generalized risk-off feeling.
Precisely. NASDAQ, on the other hand, captures volatility through slightly different channels. While they do benefit from more equity trading volume on their exchange, NDAQ also gets a substantial part of its revenue from market data services and listings. When market chaos drives up demand for high-speed, reliable data feeds because institutions are processing millions of transactions and constantly recalculating risk well, NASDAQ benefits from selling that premium data.
And what about their listing business? Does market instability affect that side of things?
Well, during market chaos, the IPO queue might slow down at first, but NASDAQ often benefits from its perceived role as a secure listing environment. What's more, their overall market services, which include surveillance and technology offerings to other financial institutions, become even more critical when systemic risk is elevated. Both CME and NDAQ offer a necessary, stable infrastructure in a turbulent environment, which makes their revenue streams highly resilient, unlike those that are purely tied to retail crypto speculation.
That structural stability is the key. So, okay, let's look at our third category of potential winners. And this one is all about investor psychology. Defensive dividend stocks.
This is the classic flight to quality within the stock market itself. When a prolonged shakeout in speculative assets happens, forcing investors to acknowledge that high-growth strategies carry a lot of risk, the focus changes pretty dramatically to capital preservation and predictable income.
They want to de-risk their portfolio, but they don't want to leave the stock market entirely. So they look for stability and cash flow they can count on?
Correct. This rotation drives capital into stable, cash-generative businesses known for their resilience and, most importantly, their history of paying and consistently growing their dividends. The dividend acts as a sort of economic anchor. It provides a measurable, tangible return, even if the stock price itself is flat or volatile. This makes these stocks ideal portfolio stabilizers.
So we're looking at consumer staples here, companies whose sales are pretty inelastic regardless of what the price of Bitcoin is doing or what the broader credit cycle looks like.
The analysis points to two ideal examples. First up is Procter & Gamble, ticker PG. Their business is really insulated because they sell necessities: toilet paper, laundry detergent, household goods. During a period of fear, people don't suddenly stop using these products.
And how does PG's diverse portfolio of brands specifically help its stability against market turmoil, say, compared to a single product company?
PG's diversity offers a lot of insulation. They operate across many different product lines, and they do it globally. If one category sees some pressure, another often remains stable or might even pick up. This portfolio diversity ensures a highly predictable operating cash flow, which directly supports their ability to maintain and grow their dividend. That kind of reliability is highly prized when the speculative side of the market is crumbling.
And our second example is Coca-Cola.
Coca-Cola, ticker KO, offers a similar, very powerful stability narrative. KO is emphasized for its robust, recession-resistant revenue base. Their cash flow model is often insulated because of their long-term bottling contracts and their massive, globally distributed market share. This reliable cash generation allows them to maintain one of the most respected dividend track records. They're what's known as a dividend king.
So, when speculative capital retreats, investors are actively looking for that long-term, low-volatility income that the PG and KO models offer, positioning them as anchors in a chaotic portfolio.
Precisely. So to summarize the winners, capital is flowing toward tangible safety, which is NEM and GOLD, market infrastructure that capitalizes on volatility, so CME and NDAQ, and stable equity income, which is PG and KO. Now, we have to pivot to the other side of the coin. The assets and companies that are facing the most intense pressure because of this severe crypto pullback. These companies are generally tied directly to the asset's price or depend entirely on trading volumes.
The narrative here is really the financial squeeze, where extreme operational leverage and dependency on volume creates immediate pain on the revenue line.
Let's start with the clearest example of leverage risk: Bitcoin miners.
Miners have a very unique operational problem when the Bitcoin price drops, which you could describe as a severe currency mismatch.
That's the key technical mechanism right there. Miners generate their revenue 100% in Bitcoin. That's the asset they successfully mine. However, the vast majority of their costs, their energy contracts, facility maintenance, hardware, salaries, interest payments on debt, all of that is denominated in US dollars.
So when the Bitcoin price falls, the dollar value of their revenue immediately shrinks, but the dollar value of their fixed expenses stays exactly the same. That is the definition of a margin squeeze.
And that squeeze is amplified by their highly leveraged structure. Because they have such high fixed costs, even a moderate percentage drop in Bitcoin's price translates into a disproportionately larger or leveraged change in their potential profit margin. This is why they are high beta stocks. A 15% drop in Bitcoin can easily wipe out 40 or 50% of their operational cash flow.
And this margin compression puts immediate pressure on their balance sheets, especially when it comes to any debt they're holding.
It creates immense balance sheet pressure. A lot of miners, like Marathon Digital, that's ticker MARA, and Riot Platforms, ticker RIOT, have used their mined Bitcoin as collateral or taken on debt to finance their expansion. When the price falls, they face immediate risks, including potential margin calls on their loans or the need to sell their previously mined Bitcoin reserves. Sometimes they call this de-risking their treasury, just to cover essential dollar-denominated operating expenses.
Being forced to sell their treasury assets just to pay the electric bill, that just adds more downward pressure on the market.
It does. Furthermore, that operational leverage means that their stock prices are hyper-leveraged to the asset's price. They move with even greater volatility than Bitcoin itself. If the market starts to perceive operational risk or liquidity concerns at Marathon Digital, so MARA, or Riot Platforms, RIOT, their stock prices can be crushed far beyond the percentage drop in the underlying crypto asset. The market is pricing in the acute risk of a severe margin failure.
Moving on, our second category focuses on the infrastructure of crypto trading itself, the crypto exchanges and trading platforms. Their vulnerability is tied not just to price, but to the psychology of the retail investor.
Their entire financial health relies on sustained trading activity, specifically the fee revenue they generate from high-volume trades, which often comes from retail participation.
We did establish that an initial sell-off can cause a spike in trading volume as people panic and sell. But that kind of volatility doesn't last, does it?
No, that volume is transient. The crucial dynamic here is that a prolonged downside trend, coupled with widespread extreme fear sentiment, inevitably leads to a massive slowdown in trading. Retail investors, the engines of these platforms, they just retreat completely. They stop buying, they stop selling, they just sit on the sidelines and wait for some clarity.
And if retail capital pulls back, the entire fee-based business model takes a direct hit.
The impact on revenue is immediate, and it's painful. Fewer trades mean reduced volume, which translates directly into less commission and transaction fee income. This is especially true for platforms whose entire financial forecast was built on the assumption that retail engagement would just keep expanding forever.
Let's differentiate the pressure points on the two key names here, Coinbase Global and Robinhood Markets.
Coinbase Global, ticker COIN, faces pressure on two fronts. First, a major slowdown in retail trading hits its transaction fees. Second, COIN has significant exposure to institutional custody and prime brokerage services. A sustained bear market means these institutions are less active and less willing to onboard new capital, which affects COIN's custody revenue and its overall growth forecasts for institutional services.
And Robinhood, that's HOD, relies more heavily on the retail user experience and payment for order flow.
Robinhood Markets, HOD, is acutely vulnerable to this collapse in retail sentiment. While they offer a diversified set of products, their growth has often been tied to high-risk, high-frequency retail trading behavior, and that includes crypto. If the primary demographic that drives their PFOF revenue in crypto and speculative stocks disappears, their average transaction margin suffers. HOD's ability to attract and then cross-sell other financial products also declines when that speculative excitement driving user acquisition is gone.
Finally, we turn to the adjacent sector, the crypto-linked fintech and payments companies. These companies aren't pure exchanges, but they integrated crypto services very heavily during the boom cycle.
We can call this the integration pain. During the bull market, companies like Block and PayPal saw integrating Bitcoin trading or custody as a powerful way to increase user engagement, to make their apps into super apps. It was a fantastic growth vector at the time.
But that strategy is highly vulnerable during a downturn. How does the slowdown translate into a tangible financial drag on their operations?
When enthusiasm decreases and users reduce their overall activity, these companies see weaker income from crypto-related transactions and spreads. But the pain is deeper than just the reduced transaction fees. They lose the cross-selling opportunity.
Explain that, the missed cross-selling opportunity.
These companies hope that a user who was engaging with Bitcoin on their platform would then go on to use their other financial services, like Square loans on Block or payment services on PayPal. When crypto users stop interacting with the asset, they stop using the app as frequently. This reduces the overall ecosystem activity and weakens the average transaction margins across the entire platform. The crypto offering, which was once a driver of growth and user stickiness, becomes a drag on engagement.
So the problem isn't just the lost crypto transaction income, it's the reduced potential for the user to engage with the company's full suite of financial products.
Precisely. That reduced potential hits their total addressable market calculation and their long-term growth forecasts, which are all built on that super app integration model. Block, ticker SQ, faces this pressure acutely through its Cash App, which has deep crypto integration. Similarly, PayPal, ticker PYYPL, which is also invested heavily in allowing users to buy, sell, and hold crypto, sees these related income streams diminish quickly as the overall enthusiasm just fades.
So the common thread among all the losers, the miners, the exchanges, and the fintechs, is that they all relied on sustained, elevated prices and volume, making them highly sensitive to a withdrawal of speculative capital.
They're essentially leveraged plays on market sentiment, whether that's through a fixed cost structure, a high dependence on retail commission, or a reliance on cross-selling speculative assets.
This analysis provides a really complete picture of the market's reaction to the Bitcoin pullback. It's a clear case study in how capital defines itself by its exposure to, or its insulation from, speculative risk.
And when we synthesize all this, the market is presenting two very distinct paths for participants. For those who are focused on quick swings and high leverage, their attention is naturally drawn to the high-beta names facing the most acute downside pressure.
Right. Those are the names where the volatility is highest, offering opportunities for sharp movements. We're talking about the miners like Marathon Digital, ticker MARA, and Riot Platforms, ticker RIOT, where that margin compression risk is being fully priced in.
And we also have to include the volume-dependent exchanges, like Coinbase Global, ticker COIN. These companies offer a lot of volatility for anyone who believes the downturn is temporary and a quick rebound might be coming.
Conversely, for the more cautious participants or those actively trying to insulate their portfolios from more speculative turmoil, the focus goes entirely to the beneficiaries, the assets that are perceived as reliable during global financial stress.
This involves rotating into traditional safe haven assets where liquidity and stability are the most important factors. So that attention is directed at the large, institutional-grade gold miners, Newmont, ticker NEM, and Barrick Gold, ticker GOLD.
It also includes positioning with the critical market infrastructure that can thrive on broader volatility and regulatory trust CME Group, CME, and NASDAQ, NDAQ.
And finally, stabilizing the equity portion of a portfolio with defensives that promise predictable income and cash flow, like Procter& Gamble, PG, and Coca-Cola, KO. The entire financial market is currently being resorted based on its proximity to this crypto pullback.
That brings us to our final thought. Throughout our discussion, we repeatedly pointed to the established regulatory framework of exchanges like CME Group and NASDAQ as a primary reason they can profit from generalized volatility.
Yeah, and this distinction is crucial for the long-term investment profile of these companies versus the pure-play crypto platforms. How might this sustained risk-off environment change the market's long-term perception of stability and, the need for regulatory oversight?
The clear difference in institutional confidence that comes from existing regulation versus the reliance on pure retail speculation and price expansion we see in platforms like Coinbase is now a measurable risk factor.
Market participants are now forced to evaluate whether platforms that rely on the wild swings of a less regulated asset can ever truly achieve the institutional trust that is essential for enduring market infrastructure, a trust that CME and NDAQ automatically command during a crisis.
We want to remind you that the discussion today is based purely on the analysis provided in the material before us. This is not financial advice, and it is not a recommendation to buy or sell any asset discussed.
This analysis is purely the opinion of the author of the material presented. Given the heightened volatility and acute financial pressures we've examined, we would strongly urge every participant to carefully manage the size of their positions in this environment.